Stephen Schwarzman is the 37th richest person in the world.
We've got to take advantage of the crazy prices that people are paying to sell half of what we bought the same day we bought it.
It's never going to happen again. We're never going to lose money. We're going to figure out a way. And it was the most important thing in the evolution of the firm besides raising the capital.
By 2030, it's expected it would be $250 billion a year deficit, not a surplus.
On June 30, 2025, Blackstone hit a milestone no other alternative asset manager has ever reached: $1.211 trillion in assets under management. That's more than the GDP of Mexico, more than the market cap of JPMorgan and Goldman Sachs combined. Over $325 billion of that is real estate, warehouses feeding Amazon's supply chain, apartment communities across the Sun Belt, life science labs leased to Moderna and Biogen, and enough industrial space in Texas to anchor entire logistics networks. In Q2 alone, the firm deployed $6.2 billion into new property deals and took in $7.2 billion of fresh real estate capital, even as valuations in some sectors dipped. Across all businesses, it pulled in $52 billion of inflow in just 90 days. From two men with $400,000 in 1985 to the world's largest landlord, Blackstone has built a 50-year playbook. The story starts with Stephen Schwarzman and Peter Peterson, both Lehman Brothers veterans, both restless. In 1985, they pulled $400,000 of their own money, rented a small office, and named their firm after themselves: Schwartz for Black, Peter for Stone. At first, Blackstone wasn't in property at all. It was an M&A boutique chasing corporate deals. But Schwarzman saw a gap. Banks were overloaded with bad real estate loans, and whoever controlled that credit controlled the assets. Their first taste came with a distressed Chicago office tower loan they picked up for $5 million. They converted debt into equity, fixed the property, and sold it for $20 million 2 years later. It wasn't luck. It was a principle. In real estate, the paper can be more powerful than the property. Control the credit, and you control the outcome. The early 90s recession was a graveyard for over-leveraged property owners and a goldmine for anyone with cash and conviction. Blackstone launched its first dedicated real estate fund in 1994, raising $800 million. The strategy was simple: buy distress, fix it, and exit when the market forgot it was ever broken. In Dallas and Atlanta, they scooped up office portfolios at up to 75% discounts. In Europe, they moved on London's Broadgate complex through a debt-for-equity swap, seizing a prime City of London address without paying full freight. They created Opportunistic Fund, targeting 20% plus internal rates of return by taking unloved properties, renovating them, and leasing aggressively. One story from this era is the Midnight Rescue. A windstorm shattered glass on a newly acquired building. Instead of filing insurance and losing tenants, Blackstone staff raced in at night, taping over broken windows so the lobby opened at 8 a.m. as if nothing happened. The lesson was already clear. In real estate, speed and decisiveness can be worth more than price. By the mid-2000s, Blackstone had a proven real estate machine and it was about to put it on steroids. In February 2007, the firm closed on one of the boldest property deals in history: the $39 billion acquisition of Sam Zell's Equity Office Properties Trust. It came with 1,800 buildings and millions of square feet of prime office space. Then, in a move that would become legend, Blackstone flipped more than half of that portfolio almost immediately, locking in over $10 billion in profit just as the commercial property market was peaking. A few months later, it went public in a $4 billion IPO. For Schwarzman, the listing wasn't about prestige, it was about ammunition. Permanent access to retail capital meant the firm could strike faster, hold longer, and think bigger than rivals who still had to beg for funds deal by deal. The timing couldn't have been better. The public float gave them dry powder just before the global financial system cracked, and Blackstone was about to turn that crisis into its next fortune. When the global financial crisis hit, commercial property values collapsed, in some sectors by 50% or more. Blackstone's response wasn't retreat, it was acceleration. The most famous example, Hilton Hotels. In 2007, they bought it for $26 billion, mostly with borrowed money. A year later, the recession crushed travel and hotel revenues, but instead of cutting and running, Blackstone doubled down, restructuring debt and investing in upgrades. When Hilton went public again in 2013, the deal ultimately delivered an estimated $14 billion profit, one of the most successful private equity real estate trades in history. They applied the same mindset to housing. Through Invitation Homes, Blackstone bought over 15,000 foreclosed US houses for about $2.5 billion, creating the first large-scale single-family rental REIT. Hotels, housing, even Churchill Downs Racetrack, all scooped up at crisis prices. And with sovereign wealth funds from Singapore and Abu Dhabi joining as partners, they had nearly limitless firepower. The lesson was solidifying. Scale plus speed turns market panic into a pipeline of generational deals. Coming out of the crisis, most big landlords were still nursing office towers and shopping malls back to health. Blackstone was already looking past them. They saw a structural shift coming, the e-commerce boom. Warehouses weren't just storage anymore, they were the backbone of same-day delivery. So in 2019, Blackstone made the largest private real estate deal in history, $18.7 billion for 179 million square feet of US logistics space from GLP. In Europe, they built Mileway, a last-mile distribution giant that grew to more than 1,700 assets. By 2022, they recapitalized it at 21 billion euros to keep it in-house for the long term. They also leaned into multifamily housing in Sunbelt markets, life science campuses in Cambridge and San Diego, and data center infrastructure before the AI wave made it fashionable. The pattern was clear. Exit fading sectors early, double down on the ones with unstoppable demand drivers. By the end of the decade, Blackstone's real estate empire wasn't just cyclical, it was wired into the arteries of modern commerce. By the late 2010s, Blackstone had built something few in real estate had ever achieved: a funding engine that didn't have to sell. The key was perpetual capital. In the US, that meant BREIT, the Blackstone Real Estate Income Trust. In Europe, BEPIF. These vehicles were designed to hold high-quality assets indefinitely, paying steady dividends to investors while giving Blackstone flexibility to buy or refinance when opportunities emerged. BREIT ballooned to over $60 billion by 2022, and when redemption spiked in 2022 to 2023, Blackstone didn't panic sell. It slowed outflows, stabilized performance, and by mid-2024 was meeting redemptions in full again. BEPIF took it further. In 2025, to land a cornerstone investor for a UK railway arches portfolio, Blackstone guaranteed a 9.25% minimum return for 3 years, something almost no rival could afford to offer. With perpetual vehicles and over $20 billion in liquidity, Blackstone could hold through downturns and pounce when prices cracked. When COVID hit, the commercial real estate map was redrawn overnight. Offices emptied, retail foot traffic collapsed. But warehouse demand exploded, suburban rentals tightened, and life science labs became gold. Blackstone didn't double down on these sectors in freefall. It trimmed them to rounding errors. Office exposure in its core plus portfolio is now in the single digits. Instead, it went all in on sectors with structural tailwinds. In 2024, it closed a $10 billion take-private of apartment income REIT, adding nearly 27,000 multifamily units in supply-constrained US markets. It also completed the $3.5 billion acquisition of Tricon Residential, boosting its single-family rental footprint across the Sun Belt. Industrial stayed a core theme, with major Texas portfolios flowing into the Core Plus strategy as part of their largest property investment year on record. Life sciences remained a conviction bet. Biomed Realty secured long-term leases with tenants like Biogen in Cambridge and kept expanding in San Diego and the UK. Blackstone also began ramping up its presence in data centers, a sector with growth curves that look eerily similar to e-commerce in 2015. The scale of these bets is backed by unprecedented firepower, over $1.2 trillion in total assets under management and $20.5 billion in ready cash, giving Blackstone unmatched capacity to strike when prices move. It's a portfolio engineered not just to survive downturns, but to treat them as buying opportunities. In the last cycle, Blackstone became the world's largest warehouse owner by betting early on e-commerce. In this one, it's making the same move with the internet itself. Between QTS in the US and AirTrunk across Asia Pacific, Blackstone now claims the title of largest data center provider on the planet. These aren't just server farms, they're the backbone of cloud computing, streaming, and AI. In July 2025, the firm committed over $25 billion to new digital infrastructure in Pennsylvania alone, a build-out designed to catalyze another $60 billion in private investment. QTS will develop and operate the sites, locking in long-term leases before the first concrete is poured. AirTrunk is just as aggressive. It controls hyperscale campuses across Sydney, Tokyo, Singapore, and Hong Kong. And in 2025, lined up over $10 billion in refinancing and expansion loans to keep growing its footprint. The playbook is familiar. Buy or build the best locations, lock in tenants with multi-decade contracts, and scale until you become irreplaceable. But data centers have one advantage even warehouses didn't. Once a hyperscale tenant moves in, they almost never move out. The cost and complexity of relocation are too high, and the digital demands curve is still climbing. It's a bet that the next prime real estate won't be on Fifth Avenue or the Thames. It'll be in the rows of racks that power AI models, mobile payment systems, and every streaming show you've ever binged. Each hyperscale facility is engineered with redundant power grids, advanced cooling systems, and physical security on par with government installations, the kind of infrastructure that makes tenant turnover almost unthinkable. Dominance on this scale always comes with a target on your back. In the US and Europe, tenant groups accuse Blackstone of fueling rent inflation and moving too aggressively on evictions in the properties it controls. Politicians in Spain and Ireland have floated legislation aimed directly at large institutional landlords, with Blackstone as the example in headlines and speeches. Its liquidity tactics have drawn scrutiny too. When BREIT hit its withdrawal limits in 2022-23, critics saw it as proof even Blackstone could be vulnerable to a run. By mid-2024, the trust was meeting redemptions in full again, but the episodes remain a reminder that scale doesn't make you untouchable. Some of its deal structure also pushed the line. In 2025, BEPIF secured a cornerstone investor for a UK railway arcs portfolio by guaranteeing a 9.25% return for 3 years, a move smaller managers say they couldn't match even if they wanted to. To supporters, these plays prove Blackstone's adaptability and market power. To critics, they raise a harder question. When one firm controls this much real estate, in sectors this critical, can anyone else really compete? 50 years in, the lesson of Blackstone's rise isn't just about timing the market. It's about building a system that makes timing less important. From the start, Schwartzman and Peterson learned that controlling the credit could be more powerful than owning the bricks. That mindset, buying distressed debt, flipping assets before the cycle turned, holding cash until panic set in, became the DNA of the firm. Going public gave them the liquidity to act at scale. Perpetual capital vehicles like BREIT and BEPIF gave them the stability to hold through downturns. And the pivot away from fading sectors into warehouses, rentals, labs, and now AI-grade digital infrastructure turned their real estate portfolio into something that behaves more like infrastructure than property. By 2025, that machine spans continents and asset classes, from Sunbelt suburbs to hyperscale campuses in Pennsylvania, Sydney, and Singapore. It's built to generate income, recycle capital, and be redeployed the moment prices break. The machine runs on a capital base drawn from the deepest pockets in the world: pension funds, sovereign wealth, and endowments that lock in billions for a decade or more. For rivals, raising that kind of money is a campaign. For Blackstone, it's a phone call. That's the real edge. Not just scale, but the ability to turn market crashes into expansion plans. It's why, for Blackstone, a crisis isn't a threat. It's a shopping spree. This is Bedlam Bear. Subscribe for more hidden stories of power and profit.